Okay, today we're talking about long-term care insurance. And instead of a cardinal lesson, this is the Cardinal Semester. Because I'm just warning you, if you've made it this far and you turned on the video, this thing is 90 minutes plus the time we have introducing it. And you say, well, why are you making a 90-minute video? Well, we were doing continuing education, Tom and I, CE, for CPAs all over the country. So they asked us, and we were actually pretty honored to do that. So we put together a program, understanding that most of these people are like consumers. They need to be educated about all the parts of the subject. And they were really most interested in the tax considerations, but tax considerations don't mean anything until you get into like why you're going to buy the policy and the basics of a long-term care policy. And then we went over tax considerations. And then what we did at the end of this is we have, in probably the best part of the video, is there's going to be 8 examples of different ways to buy long-term care insurance or something like long-term care insurance, depending upon your health. There's 8 thorough examples, and I just want to bring Tom on, and he's going to show you the show notes, because you may want to download these. Please don't print them because they're very long. But if you could have those on the side, or you can reference them later on, you can actually see proposals of these 8 examples.
Yeah, and so you can find these show notes. They're at the link below the video. They're also on our website. But like Hans was saying, is they're very lengthy. So we have a lot of people print these out. I wouldn't print the whole show notes out here. But one of the nice things that we have during the video is you'll see slides and us talking. Is on the slides, when there's a topic we're talking about, we reference a page number back in the show notes. And so I'll just scroll through them fairly quickly. I mean, it's quite long again. But if you see something in the video and you want to go reference the show notes, you can do that based off the page numbers in the video. They refer back to the show notes there. So again, look through there. Like Hans was saying, the end of the show notes, and this is really sort of started here, all the examples of the different policies. I think that's really the meat where you're going to get the most value out of the video. So take a look at that. If you have questions, reach out. We're here to help. But that's where you can find the show notes.
And you know what I'd add for those of you that maybe as soon as I show you this is 90 minutes, we may have lost you. You can do this a lot of different ways. You could go onto our YouTube channel and you could pick out about 5 videos that are 10 to 20 minutes that are on the topic of long-term care, and watch all 5 of them, and you're going to be right there at about the 90 minutes. Or you could go into this thing and you could just watch it in parts. Like Tom was saying, skip ahead maybe to these 8 illustrations of a 65-year-old, and then maybe you could back through, you could break this thing into parts. So we know it's long, but it's a very thorough explanation as we see long-term care. So with that, we want to just tell you enjoy. Okay, so the first slide we've got here is you can see how to reach both Tom and me if you felt like you wanted to do that after the program. So let's dig right into it. The first slide, or the second slide that we go through, I want to introduce Tom. Tom has been working in the insurance business and the investment business for 10 years. He started as an intern here at Cardinal, 21 years old, an economics major at UNC, University of North Carolina, just down the road from our offices, and he's been here ever since. He became a CFP by the time he was 25. Tom is an Eagle Scout, which is, boy, if I could find a few more of them, I'd consider myself lucky.
And this is Hans. He's the founder of Cardinal. He's been in the business a little longer than I have. He started at 18 when he was in school in the summers and worked through school, actually. And so he has had a long career. He's been the vice president of a large insurance company and set on his own around 2013 to start Cardinal. He's been doing this a long time. He has more designations than I can list, or we listed on there, because it just would take up the whole screen. But he's been a great mentor to me, and I'm happy to have found a job here.
Okay, so the outline for today, I'm going to start at number 3. I mean, I think we were called talking to a group of CPAs and attorneys to really talk about the tax considerations of long-term care. But if that's all we did. I wouldn't consider that adding a lot of value because many of you pretty much know, you might know more about the tax considerations than we do. And so backing up in section number 2, it's appropriate to go over the basics of long-term care and explain the policies, ensuring the risk, how the things play out, that type of thing. So we're going to go over some basics. But before we do any of that, we really got to get into the why here. Is that anytime I talk or we talk about long-term care insurance, long-term care planning, it would be inappropriate to just skip this part because this adds some meaning to it. And you really buy long-term care insurance because you love your family, because the family are the people that bear the consequences of you being needing care. I mean, it's just you're going to probably be well taken care of, and most people that are receiving care, it's been my experience, they're pretty happy about their surroundings, and they're surrounded with a lot of love and people around them, and people are taken care of. The people that really bear the consequences of this are the family, and so we really want to just jump into that, and we're going to talk about how this is personal for both Tom and me.
Yeah, and in the documents, so we'll have the presentation, but there's a set of documents that we've provided that are much longer. One of the documents in there, the first one, is really a study that was produced by Genworth. And so if you have some more, you want to read more about that, and I encourage everyone to download these documents because they will support a lot of what we're going over in the presentation here. But really what the idea behind this report was, what are the consequences of the families who provide these care. So they went out and surveyed a bunch of different families that were providing care, had loved ones that were needing care, and really put some statistics to it. And so it's not all about the statistics, but to give you some idea of really how this looks when it plays out.
Okay, and so Rosalind Carter, this is a famous quote from her, and she now has just come out in the present day that she's got dementia herself. But there are only 4 kinds of people in the world: those who have been caregivers, those who are currently caregivers, those who will be caregivers, and those who will need a caregiver. So Rosalind Carter many years ago. Okay. So I'm going to let Tom just kind of open up with his personal story around long-term care and his experience of it.
Yeah, and I think this is important because it's not about the statistics. I mean, if you get into the statistics and look at all this, I mean, I think if you're a CPA, you're inclined to look at numbers and more inclined to do that. But really where this affects is people. I mean, people are involved in this. And so I'm young to have had to experience this personally. But unfortunately, it's been diagnosed, I have an autoimmune disease. I could give you a long story. We'd be on here all 90 minutes if going through all the details. But, make a long story short is in 2018, I woke up one day and couldn't move my legs. I mean, it was sudden. It came on very quickly. We didn't know what was going on. I ended up in the hospital for, a couple weeks and then in inpatient rehab for another month. And so it was a very, very trying time. I had a 8-month-old son at the time. You can see that in the picture. And it was very hard on the family as a whole. I mean, it was hard for me. I couldn't walk. Luckily I've improved. I've been treated, and I've regained my mobility. But there was a 3-month period of time where I was very relying upon my wife to provide stuff. Get me around, help me get in and out of the shower. I mean, again, it goes on and on. But the reason that I bring this up is to give you some idea of what this looks like. It was hard on me, but it was even harder on my wife. I mean, she was the one bearing the burden of taking care of the household, taking care of our son, making sure all the bills were paid, all the food was on the table. My job was just to go to rehab and try to get better. And so I don't want to discount the difficulty of that, but just seeing it personally, it was much harder on my family. And that's really what that study provides is the burden is placed not on you, the person needing care, it's on the family who's the one providing that care. And so, I mean, that was just that's why I feel passionate about this, is I've experienced this personally and seen what that can do. And so, Hans, why don't you talk a little bit about what your experience has been?
So, there's me back when I was started selling insurance almost 50 years ago. Um, and so, just quickly, my family story is my dad. I tried to sell my dad long-term care insurance, my dad and my mom, um, let's just say in the 90s and in the late 80s. When he was retired, and he just wouldn't hear anything of it. And he was a 30-some year insurance person himself. He had a stroke in right around New Year's 1998, and I had the experience of driving him back to Florida from North Carolina. He was here visiting after 3 weeks in the hospital, and really being a caregiver along with my mom. And fortunately for him, he passed away 3 or 4 months after that stroke in the spring of 1998. And, I say fortunately because he would have been a very difficult long-term care patient, let's just put it that way. And over on the left, sitting on the sofa, is my sister Margot. And she is a nurse practitioner. She's the nurse in the family. And my mom was a nurse for 60 some years and taught nursing. And so my dad was surrounded by nurses and who were caring for him. And they would have really had a time of it had he lived an extended period of time. But as soon as my father passed away, I'm down there taking care of the money and things for my mom. And the very first thing that I did is I wrote her long-term care insurance. I was in the business at the time. And my sister Margot down there on the left, along with the help of maybe some of my other sisters, objected very, she just, don't buy that stuff. It's, it's not any good. It's, the price is going to go up. Just do not buy that. It won't pay. And so what I did is I just paid for it for myself, for my mom for a few years. And then after a while, my mom decided that she would take over the payments. And so, I tell you that because my mom, along about age 80, I mean, it's hard to specifically define when somebody gets dementia or Alzheimer's and they start losing their memory of, like, when did it happen? And but let's just say along about age 80, which would have been about 2004. And she got along just fine for 4, 5, 6 years. Living in Florida, living in a senior community. I was handling all her money, but I was always preparing with her money for, like, what happens when she needs care and how are we going to handle this? And then my sister, Margot, down there on the left, the nurse, who I very much love. So even though I'm saying some things about her, but she was then trying to figure out how to collect off of the long-term care policy that she objected to my mom buying, because my mom didn't really need a lot of care along about the 4th or the 5th year or the 6th year but she needed supervision mainly and needed care with certain things. But she's just going along just fine. And all of a sudden, Margot, my sister, who's the nurse, passed away suddenly. It was very shocking, and we had to take my mother to the hospital and actually show her Margot on life support just so she could understand what's going on. And that's when we realized how much in need of care my mom was. And my mom didn't want to leave Florida. So the other 4 of us, the 4 remaining, we flew to Florida every week in a 4-week cycle and took care of my mom and did our jobs from her kitchen table. And that went on through 2 cycles. And finally, her doctor just told her, said, look, Mary, you've got to move up closer to your children. You can't, this just isn't going to work. And so my mom ended up moving to North Carolina. We got her in a great facility. The long-term care insurance paid very well. We were really glad that we had it. My mom was also a veteran. She was a Navy nurse and served in North Korea, so we got her Veterans Aid and Attendance. And I just kind of tell you that whole story because the people that bear the burden of caring for a person that needs care, or the parents, typically are the whole family. And so when people are busy rejecting the whole proposition of this, they're rejecting it not only for themselves, but for the whole family. So enough of the teary-eyed stuff. Let's just kind of move on to the material that we were brought in here to talk about. So we're going to go over long-term care basics and just give you, I know this will be review for some of you, but we're just going to go over some quick basics. And let's just go to the next slide, Tom. And we're just going to start in with, here's the definition of long-term care insurance. And I tried to make it as short as possible. And just so that you have a definition of this is what we're talking about today. And I started with home health care because this stuff is not nursing home only anymore. It's not anywhere near that. A lot of the care starts at home, and then it graduates to assisted living and adult daycare, and then many people never go in a nursing home. I mean, nursing homes have really become rehab, the time after the hospital, and then they're certainly there for a lot of Medicaid patients, but there's your definition. So let's jump on. Okay, and I'm going to let Tom actually, but we're not into the basics. We got a history of long-term care insurance, and this is going to be done by me because I've kind of lived it, and so the first long-term care policies are out in the 70s, and I was actually selling them in the late 70s, and they had problems. They required prior hospitalization, and they had strict claim underwriting, and they were very much chastised for the insurance companies writing the policies and then actually not being there for the people at claim time. And that evolved and changed as everything changed. And in 1997, there was the insurance commissioners, the National Association of Insurance Commissioners, put forth and they all agreed on a model long-term care act. And then the laws of the land and the IRS put forth 7702B, which is an Internal Revenue Code. And it basically, if you go back and read, and it's in the notes, the whole 7702B regulation, it pretty much writes out a whole policy. Or another way to put it is if you read a policy written after the late 90s and into the current millennium, it pretty much reads just like the 7702B, the definition of care, the qualification of care, what it covers, how it covers it, is just pretty much in line because all the insurance companies wanted to make their policies tax qualified, obviously. And in the 2000s and beyond, we've lived with the problems of big rate increases. So the insurance companies underpriced this stuff during the 80s and the 90s. They just weren't charging enough for the policies, the reformed policies that actually did pay for long periods of time for care. They just underpriced it because they didn't ever expect people would be living as long as they're living, and they didn't expect that interest rates would fall to the lowest values like they have. There's a couple of other reasons, and so they had to reprice their old blocks of business, and that's pretty ugly. And so if you start reading and researching about long-term care insurance, and like a lot of consumers do that are on their way into us, I just wanted to bring that up, that's kind of an ugly period. And so that's just put a black mark on the business. It's something to acknowledge. I have answers for all that. The current policies are priced appropriately, and I'm sure you're going to see that when we get into the examples that they're much more expensive. and then there's legislation or regulation from the insurance commission that if companies of the modern policies come in and ask for rate increases, that they are going to have a hard time getting them. And when they do get them, they're not going to have any profit factor built into the increased rate. So that's just been really, it still is a defining moment. And then I wanted to throw in 2007, they passed the Pension Protection Act. And within that, it was kind of a minor part of the Pension Protection Act, but it created the tax legitimacy of the hybrid life long-term care policy, which we're going to be talking a lot about when we get into the examples, and which is really the majority of the long-term care insurance that we sell. Tom and I do.
And I think, like Hans was saying, we want to give you some basic definitions, some general ideas of like what sort of the language is in these policies. And so what we've done on the next couple slides is really give you some definitions, some ways to think about these policies. So I'll just sort of go down the list. The first one is sort of a daily benefit. So right now we're talking about really any of the long-term care policies. Sometimes they're listed as a monthly benefit, but this is what defines how much they will pay if you need care. So if it pays $100 a day or $3,000 a month, that is the maximum they will pay for that care. A lot of times there'll be a lifetime maximum on the policy, so there's a limit to what they'll pay. There's one carrier on the traditional side that still offers lifetime benefits. This is much more common on older policies, but there's typically a limit to what these policies will pay out. Once that limit has been met, you've exhausted the benefits in the policy. There is no more benefits. You've received a lot from the company, but it's over at that point. The elimination period, you can think of that as a deductible on a policy, if you will. It's something that you have to pay before the insurance company starts paying. Typically, you'll see 90 days. Sometimes you can have as low as 30 days. There are some policies that we'll sell that have 0-day elimination periods. The price is very relative to these different levers that you can pull. The larger the daily benefit, the higher the premium. Same thing with the elimination. The lower the elimination period, the higher the premium. So when we're designing policies, these are all different levers that we can pull to change the price there. And then in the inflation, a lot of policies, and we'll get this question a lot, have the ability to add an inflation rider. This is where that monthly or daily benefit increases as you hold the policy. So every year you hold it, a very typical one might be a 3% compound inflation rider. So that benefit grows by 3% and that compounds on itself as long as you hold the policy. The idea behind that is wanting to offset the inflation, the higher cost of care in the future. The next sort of slide is, again, more definitions, and this can get, we'll get into this in the examples that we've provided, but you also need to know how these policies are going to pay. You have a reimbursement benefit and an indemnity benefit. And so a reimbursement benefit is where you've hired a professional to give care, whether that be a home healthcare agency, you've moved to an assisted living, you're going into a nursing home, somewhere who is licensed to provide that care. And they have to provide receipts for the level of care they provided. And so how that plays out in reality is you go into a facility or you hire a home healthcare agency. They work with you to file the claim with the insurance company because they have to write out a plan of care. It gets sent into the company. They approve the claim, and they're sending in the bill to the insurance company. The insurance company looks to see what they paid, how much it costs, and they reimburse them. They pay that cost there. Indemnity benefit is also sometimes called a cash indemnity benefit. Is as soon as you have met the criteria of needing care, you qualify for benefits. We'll talk about that a little bit later. Then they will send you the full benefit. Let's say you have a policy that pays $4,000 a month of benefits. They will send you the full $4,000 a month, regardless of what you spent on a professional for care. So it gives you some more flexibility of how you spend the dollars. You can spend it on family members. You can reimburse them. You can spend it on neighbors, someone from the community. So it gives you some more flexibility of how you spend that money, which a lot of the hybrid policies or some of the hybrid policies we'll look at have that as an added benefit, which is a nice thing to include. some of the other definitions on here have to do with how they charge premiums. So guaranteed renewable, as we're getting a little bit specific here, but those would be the traditional long-term care policies. And what that means is the policy is guaranteed to continue as long as you pay the premiums, but the insurance company is allowed to raise rates. And that's what happened back in the 2000s, is based off claims history, they underpriced the policies, they had to increase these rates, and they can do so. They have to go through and get that approved by the insurance department of their state. They have to do it on everybody, so they can't single you out to increase the rates. But traditional long-term care policies do have the ability to raise rates if needed. Non-cancelable, this would be a policy that they cannot raise rates. They can't cancel it and they cannot raise rates. So the premium that you're paying is fixed. It cannot change contractually. They are not able to increase it even if they wanted to. And so when we look at pricing of those, if we can get a policy that's non-cancelable, that removes some of the risk of future rate increases. Hans, I don't know if you have any more to add on.
Well, yeah, I mean, the non-cancelable is obviously better than the guaranteed renewable, and you're going to have to go into the hybrids where you actually have a life insurance or an annuity contract behind this, and they can't increase the premiums on those. So.
And this is where we get into how do you qualify for benefits. So you've decided to purchase a policy, you've lived hopefully many years before needing it, and now you're sick. Now you need care. This is what almost all of the policies, and this goes back to that 7702B IRS regulation, or the IRS code, that really defines what makes it tax qualified. Most, or almost, I can't think of many policies now that are not tax qualified current policies. But they all have these same definitions to qualify for benefits. And so they define the activities of daily living. The policies, in the policy language, it says you need help with 2 of these 6 activities of daily living to qualify for benefits. The most common 2 that we use when we're helping clients qualify are bathing and dressing. And we can get into a long discussion of why that is. But the other ones are somewhat more subjective. Bathing and dressing are the easiest to prove, and so that's what we use. But they also have in the policy written that it's the 2 of the 6 activities of daily living or severe cognitive impairment. So it's not both. If you have something like Alzheimer's or dementia, you might be able to perform those activities of daily living, but you need supervision just all the time because you don't know what's going on. And so they have added that clause in there that it's if you have one of those severe cognitive impairments, that also is a trigger for benefits, and it doesn't need to be in addition to those activities of daily living.
It's real important because, look, most people that are in a facility and they got in there off the activities of daily living, then if you check all those people out, most of them have some level of cognitive impairment, many of them reaching the severe level over time. Then if you go to my mother didn't need this activities of daily living stuff until the very end. I mean, we were in like year 10, year 9, but she needed to be supervised and directed and help with dressing and help with bathing and help with medicines all the way from year 5 on. So this is an or thing. And that's just the way the regulation 7702B is written, is you either meet the 2 of 6 of the ADLs or you meet the severe cognitive impairment. So next slide. Okay, now we've finally gotten to what we're here to talk about, which is the tax code. And so just in summary, what we talked about, like why you need this. And if you get too technical in statistics, or if we got too technical of showing you the odds of needing it, the whole amounts it's going to cost and all that number information, technical information, that doesn't, in my experience, motivate people to prepare for this. If we bring up the emotional effect or the consequences that come to the families and to the family members who are otherwise healthy, that seems to get people's attention, and that's why we did it. And then the second thing is we just gave you very light in facts of what a policy looks like. And then we're going to follow this tax code business where we're going to show you a whole list of about 9 individual policies and different ways of going at this. So, and you're going to need the notes to do that. So let's talk about the tax considerations of long-term care insurance. So, and we've talked about this earlier, the code 7702B, and you can just Google that, IRC 7702B, and you're going to find this about 50 hits to 100 hits. And, you know, it's not very interesting reading, but it reads like a long-term care insurance policy. Or another way to look at it is we have a lot of people bringing policies in, their parents or our older clients that are now bringing them in, and we're going to help them with the claims. And when I sit down and read those policies, they read, if they're after 1997, they read just like the whole Internal Revenue Code does.
One thing I'll just quickly point out, and this is the same through the whole presentation, is you'll see at the bottom of the slides that we have the page number in the handout. So if you download the handout and want to go find that, we've provided that in those handouts.
Yeah, that's great. And so then the other Internal Revenue Code that doesn't really address long-term care, but it addresses early benefits or living benefits from a life insurance policy, which can be construed as long-term care insurance. And you'll see in some of the later policies that we're going to show you, they actually rely on Internal Revenue Code 101G, which is living benefits for chronic illness. And chronic illness early payments look and feel like long-term care insurance, but they're not. So one of the things we do when we're vetting, I mean, we represent, I don't know the number, but a lot, let's just say a lot, somewhere around 100 different versions of insurance that's going to pay a benefit for care. And so the first thing we're going to look at any contract that we're considering, is this a 7702B contract or is this a 101G? And so let's move on.
I'll take this slide. So one of the things that you're able to do, and we'll get into the specifics here in a second, is you are able to deduct long-term care premiums. There are some caveats to that. You need to be able to itemize deductions, which again, with the Tax Cut and Jobs Act, there aren't many people still itemizing. So that's sort of a limiting factor. It also needs to be the healthcare, this would be under that medical expense itemized deduction. So it needs to exceed 7.5% of your AGI. So again, there aren't that many people that are deducting this premium, but if you do meet those criteria, they have limits on what you can deduct for the premiums, and it's based off your age. And so this chart, again, it's provided in the handout, but you can see, you know, if we have most of our clients we're dealing with, they're in that 61 to 70 range. They could deduct per person $4,770 of long-term care premiums. And so the younger you are, the less you can deduct. One of the things that this chart I find that I use more often to refer to in our practice is these are the same limits of what people can deduct when they're paying the premiums out of an HSA. So if they have a health savings account, long-term care premium is a qualifying expense that you can pay out of an HSA. They use the same thresholds for the amount that you're able to deduct out of that. So you can't pay, you know, $10,000 out of the HSA in a single year. There's limits on that.
We don't typically talk to incoming clients. We do financial planning and we write financial plans for people a lot. And when we're getting to the long-term care portion and we're recommending people buy long-term care insurance, we usually don't even review the deductibility of the premiums for people that are just paying their own bills that are not part of a corporation, simply because so very few people meet all the gates. I mean, first you got to itemize deductions, and then if you're itemizing deductions, you got to have medical expenses in excess of 7.5%. It gets to such a small amount of people that we don't really point this out to most people unless it's applicable. Okay, let's go to the next one. And this is the part where Tom talked about the HSAs, HRAs, and MSAs. You can pay for this stuff out of there. So if people have the money for that, it's very simple, and it'll be back to the limits on the prior screen.
Yep.
Okay, so this is a place,
Back.
let's go back, yeah. This is a place that I'm thinking that if you're in private practice and you're seeing clients or servicing clients, doing their taxes, doing their accounting, advising them, it's pretty easy for an employer to pay for long-term care insurance. You can even discriminate. You can't do it through a cafeteria plan, but you can buy long-term care insurance on your employees, including yourself, as an employee, and you can discriminate. You can buy them for these people and not buy it for these people, which is very unique within health insurance. And you can buy it just on the officers. And then if you're a C corporation, you can just pay the whole premium. You're not even subject to those limits that were on the prior screen. What you're subject to is whether the compensation was reasonable. So you can't pay a single premium on an extremely large policy unless you can justify the compensation of $100,000 or $200,000. But certainly to pay off and pay 6, 8, 10 grand a year. And what we do typically with people that are interested in doing that, we'll use a 10-pay policy where we'll set them up, the whole business, with a 10-pay, so that they just spread it over 10 years. And then by the time they retire, or maybe even if they retire during the 10 years, they'll just have to finish the last few years, but yet they're writing off the whole premium. So this is really good. Now, if you're an S corporation, you can write it off just on yourself, if you're the owner of an S corporation, but then you're subject to the limits and a couple of other things. So we don't really, this is an area that's really underutilized. And if people are considering this type of thing and they own a business, this is an area where we can do some real consulting for them and get the thing paid for as a tax deduction.
Yeah, and so I mean, I think, and we have a couple slides that will get more into the S Corp and C Corp. And so this one really is talking about the taxation for the employee. So you have a business who wants to provide this benefit. What are the taxations for the employee specifically? And so, like Hans was saying, the employer can write that off as a business expense for an employee. The employee, when he then files for benefits, he'd get the benefits tax free. But again, there's more details in the handout there. We'll go to the next slide. And this is really talking about C Corps. And this is really, from a tax standpoint, this is the best deal paying for long-term care. Is especially if you have a business owner who has a C Corp, they can cover, and like Hans was saying, is you can discriminate against the class of employees. So it's not subject to any highly compensated employee rules or anything like that. Is you could pick and choose the employees you want. And so if it's a business owner, presumably they'd be doing it for themselves or maybe some of their key executives in the business. And they can pay that cost out of the business, have it be a business expense for the business and not be taxed for the employee. And it's a great way to fund a long-term care policy. Again, there's limitations. You have to be subject to that reasonable compensation rules and stuff. So it's, don't go buy the giant policy you can in a single year. But again, there are definitely great ways that this can be used. On the S Corp, which I think is the next slide, it's less, not as good. You can still do it, but it's not as beneficial as a C Corp.
Yeah, and so I think we've gone over this already.
Yeah. The taxation. So again, this is a little bit on those first slides, so we don't need to spend a lot of time here. But again, the reimbursement is, and I'll tell you why we put it here. But the reimbursement is, if it's paying for qualified care, it's not included as income in the year that it's received. If it's an indemnity policy, there are some restrictions. So you can't go buy a policy that might pay, I don't know, $30,000 a year and just
Even
30,000
a
a
month,
month. Yeah,
yeah.
30,000 a month and claim it and just you get it tax free. So there are some rules around that. This is indexed for inflation over time, but in 2023, the limit where they don't start asking more questions is $420 a day, which is a quite a high benefit. And then but then it says or qualified long-term care expenses. So if you're getting an indemnity benefit and it's more than the $420 a day, but you have care that you can back up that cost, that you could still get that tax-free. All that to say is the benefits coming out of long-term care policies are tax-free. They're not included as taxable income in the year they're received.
Okay, so $400 a day times 30 days in a month is 12,000, around 12,000 a month. We can set up a policy for somebody, either with a single premium or a series of premium, that is going to pay them 12,000 a month, and they don't have to provide any receipts. I mean, obviously they got to qualify for the care, but a lot of very well-off people, they want to get the care at home. They want to hire their own caregivers, and maybe they have a team working on it, and one of them is a medically trained professional. The other people are doing all kinds of things to make them live well in their home. I mean, 12 grand a month without any proof of any receipts. All you got to do is prove that you need the care. That's something that we could set up for somebody who's extremely well to do.
This is getting into, and again, in the examples, we'll sort of flesh this out, but these are what we would call hybrid policies, where you have a policy that's tied in with a life insurance benefit that then has the ability to pay for long-term care, and generally they have an extension rider. They pay more than what the death benefit would be for long-term care. And so this just goes into these are recognized, and then these linked benefits these linked benefit policies do fall under that same 7702B IRC tax code that allows those benefits to be tax-free.
Okay, so we said earlier the Pension Protection Act made these legitimate from a tax standpoint. And so when you have a life insurance policy that allows early payment or a living benefit for long-term care or for chronic illness, what you're doing is you're just allowed to use your life insurance benefit while you're still alive to pay for long-term care. And then you subsequently pass on, your heirs are going to get a smaller life insurance benefit or potentially no life insurance benefit because you used it all up for long-term care. And then the extension rider that Tom talked about is once all the life insurance is used up, then the extension rider kicks in and will pay for several more years of long-term care. So it's a way to, that's why they're called hybrid, a mixture of a life insurance policy and a long-term care policy. And many of them are paid for with a single premium. Okay, so now we're going to get into a debate that you all have probably not been part of, but it's kind of an inside the industry debate, and that's why I don't spend too much time on it. But there's a whole group of people that are really hooked on the traditional long-term care policies, like the only way to go, and this is all the bad press that hit on these things. And so a lot of people like us is we're right down the middle on this debate. We don't think that one is better than the other. It's just one or the other is more appropriate for any one specific client. Now, what I mean by that is the traditional people are going to say, the traditional long-term care policy people are going to say that it's the least expensive way, the least out-of-pocket, upfront way to get coverage for long-term care. So, and it's hard to argue with that. What the hybrid linked benefit long-term care people are going to say is they're going to say, oh, sure, it's more expensive, but define expensive, because these hybrid linked benefit policies, most of them are guaranteed to either pay out for long-term care and pay out more than you put in for long-term care. And if you never use them for long-term care, they're going to pay out to your heirs as a life insurance benefit. So you win either way. I mean, I've oversimplified the debate, but it goes on. It's more of an inter-industry thing. And we did a video on it because it gets brought in. I mean, we're on a YouTube channel and we put out a lot of videos. That's how we were found for this thing. Go on to the next slide, Tom. And what we got on the next slide, this is the board that we have for our YouTube videos on this particular one. And, you know, we put it up there with the writing just to give you a sense of how we try to simplify things on the board. But over to the left is a traditional long-term care policy. And it talks about all the benefits of buying that or just the facts. And then in the middle are combination long-term care life insurance policies. And then over to the far right is pretty much a life insurance policy that, oh, by the way, has some long-term care benefits. And so I don't really want to dig in. You could go in and find that video if you really want to get into a long discussion. I just wanted to say that this is over a spectrum. It's not so much black and white. Is that on the left, you've got a traditional long-term care policy, just like you've always known. And over on the right, you have a modern life insurance policy that will also give you some long-term care benefits. And then in the middle is just some combination of the two. Okay, so now we're getting into the section, I believe there's 9, but we'll find out if somebody wants to count them as we're going through here, is we went through and put together a policy. Some of them are a combo policy on a husband and a wife or a couple. They're both 65. Some of them can only be written on a one person. And so we did it on a 65-year-old, and some of them are on a female, some of them are on a male, but what they have consistency through all 9 of them is they all pay benefits for long-term care. I mean, and that's the primary objective of the people that are buying these things, is they want to have payments there and money there if they face long-term care. So the first one is that traditional long-term care policy from Mutual of Omaha. It's mutual care. We're not giving you a lot of facts, but if you look in the handouts from pages 50 to 53, we actually have a proposal for these people. And, you know, it just shows you it's $6,000 a month. It's a 3-year policy, so that is a $216,000 maximum. It's got a 90-day elimination period, and that's a lifetime elimination period. So it, you know, if you use a little care here and a little there, it adds up. It's a calendar day elimination period, meaning if you have care on Monday and you have it on Thursday, and then the next week you have it on Monday, Wednesday, and Friday, that's not just 5 days. That's every day from Monday till a week from Friday. So they count the days you didn't have care at home, but it needs to add up to 90, and then the policy starts paying. It has a 3% compound inflation, so that $216,000 maximum, if these people don't use this till they're like 85 or 90, is going to be substantially higher. And what we got on the bottom of the slide is for the man here, and this is not a completely stripped down policy, but this is has some substance to it, but it's certainly not the biggest or the longest policy. $3,500 a year for the guy and $58.99 a year for the lady. And then if the two of them buy it together, there's a discount for being a couple.
And I will point out, so on the elimination period, not every long-term care or traditional long-term care policy does it on that calendar day basis. Some are service days, meaning you actually need to have received care in that day for it to count. So that's some nuance that you just want to be aware of if you're comparing policies side by side. And I'll just reiterate the difference in the price between the male and the female. I mean, it's pretty typical of all these companies is they charge women a lot more for long-term care than men, and statistically women need it more often, and that's why they have to charge more for it. So you'll see that throughout the examples that women cost more to insure for long-term care than men.
Okay, next slide.
Give it a second, I'm afraid to, here we go.
Here we go. Okay. This product is a way to use IRA money, because this is a problem we run into in our business. We write about 8 to 10 financial plans a month, and people coming into us, most of their assets are still in the IRA. A lot of the people that are coming to us are 64 and a half, 65, just retiring, thinking about retirement, already have retired, and most of their money is in an IRA. So when we start talking about some of these other hybrid policies, and we're going to need $100,000 a piece to single premium, it is a lot of people just don't have that kind of cash except in their IRA. So we have one company who, there used to be a patent on this product, but it's expired now. And it's a way to take a hunk, like in this example, which you'll find the whole printout on pages 54 to 60 in the notes. 200 grand. It covers the husband and the wife, 65 each. And they roll it over from the IRA or 401k it's in to an IRA at the insurance company that is an annuity. So there's no taxation, a tax deferred rollover essentially. And then that annuity is guaranteed to pay out 25 grand a year for 10 years. And you'll notice 25 grand a year times 10 years equals $250,000. So there's $50,000 of interest inherent inside of the annuity that's already just credited right from the beginning. So there's $25,000 a year coming out of this annuity that goes to pay the premium on the life insurance long-term care policy, because that's a 10-pay policy. So you got to go through a lot of gyrations, and we lose some people, some of our clients, if we're going through this quickly, which we don't do, and we go over it and over and over again. But where it's leading to is you can take $200,000 of your IRA money, cover a couple, roll the money over to this, and you're effectively buying two policies. One is an annuity that's an IRA that has $200,000 in it in the beginning, and then it shoots off 25 grand a year that pays into the life insurance policy for 10 years. And that what it creates is a $6,754 a month long-term care benefit out of the base policy for 33 months, covering both of them. So if one of them or both of them are in there, they're going to blow through the 33 months. And then when they do that, it goes into the extension rider, and it's going to pay that $6,754 a month for long-term care for life. It's unlimited. So this thing could pay out millions of dollars. And what they do is the $200,000 transfer one time. Now, something that's unsaid is they have phantom income that they got to pay taxes on. So that 25 grand a year coming out of the IRA and going into the life insurance, that's taxable income for 10 years. So we always got to point that out, and we've got to create the money in their income plan to pay those taxes, but it also counts as an RMD, or a required minimum distribution. So, and we have a lot of people that buy these things when they're 70 or 73, 74, 68, and that, you know, that's a benefit and a factor for them.
Yeah, one of the things that I will say, and when we're doing our financial plans, is we use this policy specifically a lot as part of a larger tax plan because we have a lot of our clients that we're recommending Roth conversions on, given where tax rates currently are and what we expect them to do in the future. And so this is a way to, we are already planning on distributing their IRA systematically over time as part of a Roth conversion strategy. We use this policy to substitute some of those converted dollars, and as the 25,000 coming out of this policy, we would just reduce the Roth conversion by that amount. And it fits a lot of boxes that we do in our plans where we're planning for the long-term care, which again is one of the larger risks that they face. We're using the IRA money, which is what they have. This policy doesn't have any risk of increased premiums, which again is one of the concerns of the traditional policies. Yes, it is more expensive. The traditional policies aren't going to take $200,000 up front to do it. But if someone has, $2 million in their IRA, taking a portion of that out, covering this risk as part of a larger plan, we use this one a lot as part of our financial plans.
Absolutely. Okay.
This is just again, you'll find this in the handout. This is the same policy, but it gives you sort of a graphical visual of how this works. And so again, you put the 200 in, it's distributing the $25,000 annually for the 10 years. It then provides a monthly benefit of $6,754 a month. And again, it's a lifetime policy. So there is no end in benefits. You could never exhaust this for long-term care. The full, again, and all these examples, the full proposal is in those handouts.
So, okay, so now we're going to show you a linked benefit, life, long-term care hybrid. It's called Secure Care. And again, it's on pages 61 to 92 in the notes. And the benefit of this policy, like, why would you buy this one over the other one? Well, first of all, this can only be purchased with after-tax money. You can't buy this one with IRA money. So, but you can spread the payments over time. So in this example, we're showing it funded on one person with a $100,000 lump sum. But if you want to buy it on a couple, you put in 200 grand. But this is going to require somebody having 200 grand laying around that they can stick into a single payment long-term care policy. So this has a 10 pay option to it as well. So it's going to be more than 10 grand a year for 10 years. And it's got different pay options, but just so you understand, this thing has an indemnity benefit. The policy we were showing you beforehand is a reimbursement policy. So if you were going to get that $6,700 a month for long-term care, you would have to prove that amount of expenses. And if you only spent 3 grand in that month on home health care, you're only going to get 3 grand from the insurance company. With an indemnity policy, and this one is producing $6,470 a month, if you qualify for care, you're getting the $6,470 per month. You're just going to get a check for that amount every month. We didn't put inflation on here because a lot of times with these hybrids, you get, when we put inflation on here, you get substantially less life insurance. And more importantly, you get substantially less in your basic benefit. And then it takes about 15 years for the lower benefit to catch up to the higher benefit. So a lot of times our customers end up buying a larger benefit with no inflation. And because it's an indemnity, they're just going to get a check for the full benefit if they start using it.
I will say, if you have clients that are younger, in their 50s or so, a lot of times the inflation looks more attractive in those scenarios. But in our clientele, the 65 to 70 range, a lot of times we're not adding inflation on these hybrid policies. On the traditional policy, we almost always add inflation on those policies.
Sure. And so this one is on a male. If he buys it, never uses it, his heirs get 155 grand back after his death. I mean, so if he uses it, but maybe just uses it for 3 months and then he passes away, kind of like my dad did, then his heirs are going to get like 130,000 or 140,000. If he uses it to the max and he blows through all the life insurance and he's into the extension rider, his heirs are still going to get the $10,000 residual life insurance. So there's going to be something coming out of the life insurance policy at the end. And for the guy, this is 100 grand that he's dumping in. To get the same benefit, a woman would have to put in 115 grand, or it'd be about 15% more. Or another way to do it, for the same 100 grand, she's going to get about, 85% of the benefits that he got. So there's a lot of flexibility in design with these things. We're just trying to go through and show on the same people different ways of getting at the problem, and then doing it on the same people, and then explaining to you the situation where we would use these. Okay, next one, Tom.
And again, this is just a picture that, graphical version of what was on that previous slide. Sometimes it's easier to understand what's going on here. But again, you have the day one death benefit there. We have the extension rider. And so the total long-term care benefit is a 621. I think something with all these linked hybrid policies is it's important to understand is the first dollars that you're spending for care is reducing the death benefit dollar for dollar. This particular company has a guaranteed minimum of $10,000. So if you used up all the long-term care benefits, there would still be a death benefit of $10,000. It's not a lot, but that would go to your heirs. But again, the first dollars you're spending is spending down that death benefit. And then, so if you use $50,000 of care, you'd have a death benefit of 105 left going to the heirs. So, and that's the same way on all these linked policies.
Okay, so now we have an annuity that is a long-term care hybrid. And so, why would you use an annuity? Well, I mean, if I have a choice, I'm going to use a life insurance policy over an annuity. Okay, just tax-wise, benefit-wise, just you're going to be better off with life insurance. So does that make the annuity bad? No, there's just reasons. Number one, we can use an annuity because of a person's health. There are people that have certain conditions that can get the annuity care who can't get the life insurance, long-term care. So we could get into why that is. So the first one is health, is we know the underwriting on all these contracts. And then we have several annuity contracts that also offer long-term care, and who they'll take health-wise is always easier than the life insurance, but it's different from company to company. So we have just experience, and we've worked with these companies, and we have their books we can read. We kind of know when a person has a certain kind of health condition, at a certain kind of bad, who we can slip in on something. And sometimes we put spouses on different policies just for that reason, is one of them's healthy, one of them's got some sickness, and we have one of them on the healthy policy and we have one of them on an annuity. So that's the first reason, is health. Second reason is if you have some clients that have older annuities that maybe they put in 100 grand 20 years ago and it's now worth 230 grand, and it's a non-qualified annuity, and they've got 100 grand of principal, and they got 130 grand of deferred interest, and they're probably just going to let it lay there. And then when they pass away, their children or the beneficiaries are going to have to deal with that $130,000 of accrued interest that they never paid tax on. We get into helping a lot of people like that with things they've inherited from their parents. But there's a way then to never pay tax on the 130 grand of built up interest, because we can use it to pay for long-term care. If this has a 7702B rider on there. So we're just going to roll over that other annuity into this and then set up a long-term care payment. And then if they never use it, then it'll pay out just like the other one did at their death to the beneficiaries.
One of the things I will say on these annuities is there's not an inflation rider that you can put on the annuity, and so the annuity has, some of them are a fixed interest rate, some are indexed annuities, so it just depends. But the growth of the annuity is how you account for the inflation, because as the annuity balance grows, that produces a higher monthly benefit for long-term care. It's proportional to that benefit. And so as the annuity grows, you have a higher monthly benefit. It is a great way if you have a large deferred non-qualified annuity that has pent-up gains. It's a way to do a 1035, put it into this policy that then would, if it did pay for care, those dollars coming out would be tax-free. You wouldn't have to pay tax on the growth of that annuity.
So, okay. So now here's a different kind of annuity that instead of just how it pays out, it's either going to be 2 times or 3 times the amount of money they put in here. So to make this thing simple, male or female, they charge the same rate on this policy. You put in 100 grand. It's just like any other annuity. It's going to earn interest every year. Probably not a lot, but it's going to earn interest. And then it's going to have a charge for the long-term care insurance. And the long-term care insurance, if they're reasonably healthy, is going to be an additional 2 times or another $200,000 on top of their $100,000 that they put in of extra long-term care benefit. If they've got some sickness, but it's not, they're still insurable, it might be 2 times or another 100,000 benefit. And so when it comes claim time, they use their own $100,000 first. So like in this example, it pays $4,289 a month for long-term care. And all you're doing in the first, 20 some months is they're just giving you back your own money. So if you use this, collected the money and passed away right at the, time you can do the math, the 25th or the 30th month or whatever it is, you've just been given your own money back. But if you keep on collecting, now you're into the insurance company's money, and that can go on for as long as 3 times your original amount or another $200,000. And then these numbers are growing with interest. And there is a guarantee that the charge for the long-term care insurance will never be more than the interest credited. In other words, you could never go negative in a year with really low interest. So people like this, and they put it there, and you can actually put 2 people on one of these policies, a husband and a wife, but we're just showing you an example of one.
The main difference between this company and the one from the previous slide is this one needs to be non-qualified funds, money that's already been taxed. The previous one you could use IRA money for. So again, there's differences, there's reasons why we might use one over the other, but this just gives you an idea of what some of these different policies might look like.
Okay, now this is one that's relatively new that we've just written our first one. But this is for people that have some pretty serious illness. Well, basically nobody gets turned down for this. So if we've got people that are facing care, or maybe they're not facing care, they're young, but yet they need a lot of care in the future, or they see that they could, and they've got health conditions that prevent them from doing an annuity, this is their product. And we don't want to go into a lot of detail on it, but they use a different kind of underwriting. They actually do it on a video, and they're checking for the people's mobility, and then they do a cognitive and awareness test. So we've got a guy that we're sending in right now that's very sharp. He's very agile. He's in very good shape, but he's got some medical history problems that prevented him from buying some of those other long-term care policies. But we're thinking he can get this. and he's going to pass their underwriting test on video in flying colors. So we just want to show you the whole spectrum here.
And I will say this one is useful because it's it's always works out this way that the people coming in wanting long-term care are either one of two people. One, if they're reaching out to us asking about it, one, they've experienced it with the family member and they don't want to put their family through that, so they're wanting to plan for it. Or two, they've just been diagnosed with something that they might really need this in the future and they're trying to buy the insurance now. Well, insurance doesn't work that way. Once you need it, you can't buy it. You can't go buy home insurance when your house is on fire. So the same thing with long-term care. What's nice about this policy is if they have a diagnosis which prevents them from buying any of these other policies, they could still get this policy if they still have their mobility about them. They still are moving around just fine. And so this isn't the first one we would go to. This is more of there's really underwriting concerns. This is a nice one to have, but it's very useful for those clients who really want the care and can't get really anything else. This is very helpful. And again, it can only be used with non-qualified money. So it's not IRA funds. And so again, that's somewhat limiting just based off of what kind of money the client has. But again, we have several that were several people that have one of the other ones that we're going to go back to and look at this for them just because it's a helpful policy.
Okay. Now, we have a number of people that come in, and we're going back to that IRA policy where we're taking 200 grand out of their IRA, people with large IRAs, and then we start talking to them and showing them how they can shift this, spread the taxation out, and get long-term care insurance that if they never use, goes to the heirs for more than they put in the first place. That's a pretty attractive proposition. We have a lot of people wanting this and that go forward with it. Then we have the problem is one of the two spouses gets rejected for the insurance. Because when they start offering these lifetime benefits, these companies get a little picky. And sometimes they're situations that just don't really come up in the beginning, but then once they get medical records and they look, anyhow, we have people where one of the spouses gets declined, and it's really hard to convince the other person to keep the healthy person or a healthy spouse to keep the policy, but we're adamant about that. That okay, so you're going to take care of her. She's going to need care. If she's not insured, I mean, spouses, when your spouse needs care, it's going to be hard on you whether you have insurance or not. And then sooner or later you need care and then you got no insurance for it. And we've blown through the money paying for her. So what this is this is what we're going to put on her. And we've got several instances of this. So we have an annuity that promises a future income. And the longer you wait to take money out, the more you get. And then once you start taking money out, you get the money for the rest of your life. You get the income for the rest of your life or the rest of the life of both spouses. So this is a very attractive thing, not to throw all their money in here, but to have a guaranteed future income that if one of you lives to 100 is never going to stop is pretty attractive. So this thing is attractive in and of itself to a lot of people. And then it has a feature covering both spouses that if you start the income and then one of you needs help or needs care, let's just try to simplify this, the income amount can double. And it can stay doubled as long as 5 years, okay? And as long as there's cash value in the policy to pay the income. And then when you run out of the doubled benefit, the benefits don't stop. It just goes back. If somebody's still living, it just goes back to the original amount and pays that for the life of both people. So I'm kind of babbling here that there's an illustration of this, and we just showed you 100 grand. We usually don't sell this in a unit of 100 grand. We're going to do it more like 400 grand or 500 grand or 600 grand, where we're really setting up a future income. But in the back of our mind, we know that this person that was rejected for long-term care insurance, if we double the income for long-term care, we're going to do it on that person, because the other one still has the long-term care insurance to fall back on.
I will point out, so on the slide it says not IRA money. You can use IRA money on this, so that was a typo on our end. But so you can use IRA, you can use non-qualified funds on this. Generally, we're using this as a broader financial plan. We're not going to just start here if it's not in part of a bigger picture. We're, in other words, we don't want to tie all of someone's money up in this thing only solely for the purpose of long-term care benefits. It needs to be serving other roles. But for people who really can't get it, this is wonderful. And we have a client right now had bought a couple of these several years ago that has claimed this doubled benefit and is helping pay for her care as we speak. And so it is very helpful when that time comes, just to have additional money to cover that cost.
Yeah, we even have people on the flip side that just don't feel like they can afford long-term care, but they still need us to plan out their income out of their IRA and then, or their 401k or whatever. And so we'll put part of it in one of these, defer till later, start the income that's going to last as long as both of them do. And it's just kind of a nice thing to know that if one of them needs long-term care, we have the ability to double the income. So it's kind of an afterthought. So yes. So this is one of my favorite products, because now we're back on the people that get turned down for long-term care for whatever reason. Our first thought is, are they in one of the states that offers this? Because we've only got it in 39 states. But if they are, this policy does not ask, have you ever been turned down for long-term care insurance? Or did you try to buy a policy and they said no? And it has fairly easy health qualifications. And what the policy will do is it pays you $1,200 a week if you need home health care. There's a 0-day elimination period, so you don't have to wait 90 days or anything. So you have home health care, $1,200 a week. It's an indemnity policy. All you got to do to get the $1,200 a week, first you need the care. You need to prove that. And then you need to have 3 visits a week to your home by a licensed home health care agency. Once you do that, they send you a check for $1,200. And it's got a 52-week maximum. And so, it's going to pay out $62,400 as a maximum, just for home health care. And we can sell that as a standalone policy, but most of the time we combine it with the facility care policy. $200 a day, $6,000 a month, 360-day maximum, which is almost a year, 72 grand. That's a separate benefit from the home health care. And I sell this to a lot of well-to-do people that are just not going for the long-term care. They say, I'm going to pay for it myself. Okay, great. Pay for it yourself. But that sounds great for very well-to-do people. But if you've ever sat down with an 88-year-old man with his daughter there in the room and tried to convince him to come off of some of his millions, to have somebody come in there and take care of him, I have situations where he's throwing them out of the house and he just doesn't want those people in there. And then when they go for it, the daughter doesn't know which account. I mean, it's a problem for well-to-do people. Their self-insurance business isn't as pretty as people imagine it. And so this policy is going to give them a year at home with some benefit. It's going to give them a year in a facility. And they can use that year to figure out the self-funding. So there's a lot of uses for this thing. And I was just going to say, it's not in California, it's not in Florida, New Jersey, New York, Washington, a few other states. It's in 39 states, but we use this thing a lot to supplement products to supplement situations, when we do it in combination with that annuity that we were talking about that had the doubler effect. So when people come in to see us, or they were doing them on Zoom, most of the time after we've been talking for a while and they've been watching our videos, they're ready to buy some long-term care insurance. And then when we run into people that have health conditions or limited finances, or maybe they have a lot of income and low assets, or vice versa, we've got a whole range of things that we can access to get them some benefits if they need care.
And I will say, so on this particular policy, the underwriting is much less strict than some of the other policies we have, and this is a real benefit because there's a lot of people that just health-wise can't qualify for the other things, and so if they don't want to do something where they're taking a big lump sum of money and putting it somewhere, which is a lot of people, they can't qualify for the traditional long-term care. This is a wonderful product to be able to get them some benefits. I mean, 2 years. I've never had someone who's filed claims on this and has been upset that they got those benefits. I mean, they maybe wish they could have gotten more, but they were extremely happy that they had those there. I have a client, he's just coming to the end of his year of needing these benefits. It wasn't ALS, but it was something kind of similar that he was diagnosed with, and he was able to qualify for a version of this policy that he could get, and it's been paying benefits, and we're just now at the end of the year, and his family is just, over the moon that they haven't had to pay that care for that year. And so it doesn't solve every problem, but it's very helpful if it's needed.
Sure. So, I mean, our experience that we're bringing to the table about long-term care is unique, I feel, because most of what you've gotten today really comes out of our work. I mean, as you heard earlier, I've been selling long-term care insurance for 40 years, and Tom's been selling it for 10 years. And we have a YouTube channel that just kind of happened, and it's been around for about 4 or 5 years, and there's over 200 videos on there. And we don't really have to hunt for material because we're practicing, and it's kind of walking in the front door. And so when we go through this consortium, it's like our brain, when somebody's sitting across the table, we're looking at their assets, we're looking at where all the money's positioned, we're looking at their income and their Social Security and their health. I mean, this whole spectrum of these 9 policies is coming through our brain to figure out what combination we're going to put together to solve their problem. And what I want to add to that is long-term care is just one of the 7 worries that we address. So in our business, when we do a financial plan for somebody, it's Social Security, Medicare, long-term care, we have a specific section for IRA planning, because most people have a big hunk of money. They've never paid taxes on most of it, and now they're retiring, and somebody's going to pay a big tax bill on that sooner or later. And so we want to address that separately before we get to income and their other money. And then the 5th worry is we're going to look at a retirement income plan and an investment plan to make sure their money lasts their whole life. And then we add in estate planning, and the long-term care, even though it's its own section, is part of the estate planning. And then the last section is income taxes, where we put together a tax plan for them. So I just wanted to point out that we have a good expertise on long-term care, but it's just one of 7 things and 7 areas that we're addressing in our retirement plans. And we also have a unique experience that, in my background, I'm licensed in all 50 states and the District of Columbia, and that's from a prior job. And I've just maintained that. And I also have a bit of experience because this insurance is regulated by the states. So all of this stuff is a little bit different in every state. And we have experience with that. And as in the modern day, we're doing business over Zoom. People are learning about us on YouTube with our educational videos. And so we we don't really have to hunt down content. And so when we made this presentation for today, we really treated you all like you were hearing about this for the first time, like a lot of our consumers, and just went through, a high level show on it.
One thing that I want to bring up and just sort of bring to the table is when we're dealing with this, and we bring this up with most clients that we're doing plans for, there's common objections that we hear very frequently. And either your clients might be facing it, you guys might be thinking this, but one common one is just that, hey, my kids are going to be here. They're around. They're going to take care of me if this happens. There's no guarantee this might happen. They'll just take care of me. What I will say to that, and Hans has experienced this as a child, is your kids are going to be involved in coordinating that care. I mean, that there's no question that even if you have the insurance, they're going to be involved there. The question then becomes is, do you want them doing that heavy lifting? Like, when I was sick, I needed someone help to get me in and out of the bath. I needed help going to the bathroom. I mean, there was a funny story. I mean, I was in the hospital. I was sort of right after the most serious thing. I was in a walker. I really couldn't walk very well, but I was like, I really want to shower. It's been a week or so since I bathed. And I convinced my wife I can make it. I get about halfway there, and it just became very clear I couldn't. And so she's trying to get there, trying to help me. She's, young and strong, and she can barely hold me up. And then we're having to call nurses. And luckily it didn't turn bad. But if you're trying to do that on your own, or your kid's trying to do that on your own, I mean, presumably you're going to be in your 80s when you're needing care. Your kid might be in their 60s. Are they going to be able to do that safely? Probably not. I mean, then you run the risk of falling and re-hurting yourself, or, breaking a hip or something like that. So the kids are going to be involved. It's just not, you don't really want them doing that stuff that, you kind of hope you never need. And the reason we use the hybrid policies a lot is this is insurance. I think we're very passionate about it. If you never need it, the death benefit at least goes to the heirs. It's money that doesn't feel like you've just spent and have walked away from it. But if you do need it, it provides just a wonderful benefit there.
Yeah, thanks, Tom.
So what we're going to do now is sort of field some of the questions that have come throughout. So Hans, what I'll do is I'll sort of read them out to you, and then we'll sort of have a conversation about the questions. So when you purchased the long-term care policy for your mom, so this is when you did this, did she claim the deduction on her taxes? Were there gift tax implications?
She didn't claim it on her taxes because she didn't really have enough income to get beyond the standard deduction. Seems like a lot of our clients.
I will also point out, so for the gift tax implications, as long as I'm going to use today's dollars because, again, this was many years ago, and I don't know what those numbers were. But in today, you could give, I think it's up to 16 or 17. You guys probably know that better than I do. I think it's about 17,000, I think, is what you can give and not have to claim it on a gift tax exclusion or state tax. It doesn't count against that. And so even if you were doing that as a gift, which is what you would have been doing.
Which is what I was doing, but
right.
Then it would have been on my tax return.
And you would have been under the limit.
I would have been under the limit, but I probably could have claimed premium that I was paying for my mom as a medical expense on my return. Okay.
But then you probably would have met
I wouldn't have met all the I made too much money.
Yeah. So it's a good thought. I mean, there are situations where that might be useful, but in that situation, I don't think it was.
Let's get a bunch of questions here. Yeah.
So the next question, how do you address the risk of future premium increases and the long-term care going out of business?
Okay, so that's two questions on there. How do we address the risk? Well, on most of the policies that we put up here, other than the traditional long-term care and the short-term care, all the hybrids, which is most of them, there can be no rate increases. The rates are as they are. I mean, so there cannot be a rate increase. So that the way we address that, if that's a big concern for people, we just sell them a hybrid, because actually with the premiums, there's not a lot of difference in the premiums if you spread them over 10 or 15 years. And then the second issue is, are the insurance companies going to go out of business? And we try to deal with A+ companies, but that's one that I can't promise that. But it's one of those things is when that's a stop sign for people, and sometimes it is, um, they're going to go bankrupt from the long-term care bills a lot quicker than the insurance company is going to go bankrupt from paying their claims. Okay. And so that's a tough one, though. If somebody's really got it in their mind that they just don't trust insurance companies for the reserves, I mean, that's one that we're just not going to be able to overcome.
Yeah, I mean, I think, logistically, what ends up happening when most companies get in trouble is they end up selling their business. Another insurance company takes over that. So there are not a lot of examples of insurance companies just going completely out of business and leaving the policyholders, holding the bag. Is it a possibility? Sure. I mean, it could happen. That's why we want to deal with well-diversified companies, one that have good financials. We look at their financial ratings. But yeah, I mean, if someone is really convinced there, in my experience, that's really more of an excuse of not to buy it. They don't want to address the problem. They don't want to think about them needing care. And so they're looking for reasons to not purchase a policy. And ultimately, we're going to go maybe a couple rounds with them, but not everyone's going to buy this. And we recognize that. And so we're sort of sifting through. And if they're there, we're going to help try to set them up the best they can without this. And then they're just sort of taking on that risk. I think
let's move on.
We got about 2 more, so we got some time.
Yeah.
And so
Okay.
the other thing on the future premium increases. So that really, I mean, historically they have had large rate increases. There is no doubt about that. That is definitely true. Hans talked about this. Part of it was just a mispricing of the policies when they were first selling them, and so in a effect, what they're doing now is they're charging a lot more on the front end, which is probably needed to get you some details. And again, if you want to go way more detail, you can call us up. But some of the big assumptions they missed when they were first pricing them was one, interest rates. That's the big one. A big one that's not often thought about is the lapse rate. Is they were just coming out with these policies. They didn't know how many people were going to keep these policies and who is going to drop them. From an insurance company standpoint, when someone drops a policy, that's just pure money coming into the business. Their business is that they don't have any liability anymore. All that premiums they've been setting aside as reserves. They get to then put that in their bank and use it. And so they were assuming some lapse rates. And what they have found out is when people buy a long-term care policy, very, very few drop it. Is they hold it until they either use it or until they die. And so that was something they missed a lot. And then also just people are living longer, they're needing more care. So there were a lot of bad assumptions the actuaries made that really caused that issue of having really large rate increases. A lot of that has been, I think, fixed to a large extent. It's not to ignore the fact that they could go up. When we're selling a traditional policy, we sort of prepare the client, hey, this might have a 10, 20, 30% increase over the life of the policy. But again, it still makes sense. With someone who's really concerned about that, the hybrid policies might be a better fit.
That's good.
The next question, how do veterans and their benefits play into a long-term care policy?
Okay, well, my mom was a veteran, so was my dad. And there is such a thing as veterans aid and attendance. And it is not a reimbursement of long-term care. It's more of a pension benefit. So if a person qualifies for the veterans aid and attendance, and they also have a long-term care policy like my mom did, the two don't really work against each other any more than her Social Security check coming in every month. Because one is a pension, the other is a reimbursement for actual long-term care expenses. And they may be asking a little bit about, there are veterans facilities where there's a pretty long waiting list for those, and it needs to be a service-related injury a lot of times to get to the top. But you can go to a veterans facility, and there is no charge for that facility. So my thinking is the long-term care policy is not going to pay anything for that. And people that anticipate going there are probably not going to buy a long-term care policy in the first place.
I will also say that a lot of the veterans programs are means tested, meaning they're going to look at your income, they're going to look at your assets. And so the program that your mom qualified for, the Veterans Aid and Attendance, they have fairly strict, and it's gotten strict over the last couple of years, qualification. I mean, they want to make sure it's people who are actually in need that are going to get the benefit, which I think is reasonable. And so
you could plan your way around it in my mom's day, which was 10 years ago, 12, 14 years ago. We could make her poor a day after she was middle income with use of a trust. You can't do that anymore.
yeah, I mean, they have essentially adopted a lot of the same Medicaid rules, where there's a 60-month look back for any gift or any transaction that's done. And so, if there's a client that has a lot of money, they're wealthy, and they're a veteran, the veterans programs are probably not going to be available for them. Now, if someone is on the lower side of the socioeconomic kind of their status, they don't have a lot of means, then those veteran programs are wonderful. I mean, it could be useful for them. But again, those are not the people that are really looking at buying long-term care policies. So the veterans benefits are there, but like Hans said, a lot of times it needs to be a service-related disability that's led into needing the care before you can actually go into a facility that will pay that. So that's how those sort of coordinate with each other. Next question, can a hybrid annuity with long-term care be purchased as a QLAC? And so I can sort of take this one. And so there's a lot of things in there. So we're dealing with hybrid annuities, long-term care, and a QLAC. So let's just define a QLAC, if you don't know, is a qualified longevity annuity contract. It's a type of annuity that allows you to put money in now, not have to take it out. I think they'll let you extend it all the way to age 85. One of the benefits is, and this would only be used with IRA money, is then you don't have to take RMDs on the money that's sitting in that QLAC. So it's a way to put money there, remove it from your IRA balance. The RMDs, required minimum distributions, are not calculated based off that, and then it starts an income in the future. So the question, can a hybrid annuity with long-term care be purchased as a QLAC? The short answer, and I think where they're asking, is no. So these type of annuities that we looked at, these hybrid annuities that have long-term care benefits, would not qualify as a QLAC. A QLAC is a specific type of annuity. It's a deferred income annuity. And so you set, when you sign up for a QLAC, I actually have a client, I'm doing this, I talked with them yesterday, but with a QLAC, you set when that income is going to start when you're applying for the policy. So you apply now, and it's going to start in 20 years. That wouldn't be, if you were buying it solely for the purpose of long-term care, and that was the main thing we were trying to solve, it doesn't really solve for it perfectly, because the long-term care is at an unknown time in the future. We don't know when that event's going to happen. The QLAC is set to start at a certain time. The long-term care event, we don't know when that's going to be. And so, in short, the answer is no. You can't mix those two together. I have seen people use it as sort of, they have plenty of means. They have the money to pay for it. And they've used the QLAC as a way to say, okay, if I need care, it's probably going to be in my 80s. I'll just have a policy that's set up to produce more income that can maybe help cover if I'm needing costs there. So in a roundabout way, potentially. But, the way I think the question is asked is no, those cannot be combined. And so I think if there's any more questions, people can ask them. But Hans, I'll ask you a couple of questions just directly. And so in your years of doing this, what have been some of the most common objections, maybe ones we haven't discussed yet, that you'll get when you bring up the need of long-term care?
Well, we don't get this in the present, but when I used to be like reaching out to people, or my salespeople were, and then we'd be going and seeing them and kind of forcing this issue on them or trying to do that, people would just say, I'll just do myself in, I mean, we'd get that more often than you think.
Right.
We don't get that very often now because the people are calling us. And so that's kind of my, what do you do with that? And then people just say, my kids are going to take care of me. Okay. We don't get that one as much as we used to. I'll tell you the one that we commonly get now still, I'm just going to pay for this myself. Before I take $100 and some thousand and transfer it to you or your insurance company, or 200,000, I'll just pay for this myself.
Yeah. I mean, I think that is definitely something we get a lot. And one of the things that I often tell the people, and we see this in our practice, with our older clients, is they're not spending any of their money. Is they've saved all this money over their life. They've been very frugal. They have these large balances, and they're not spending any of it. Say, well, why don't you go take that trip you've been wanting to take forever? Why don't you go, pay this for your grandchild or something? And the answer always comes back is, I might need this in the future. When you push them on that, what are you going to need this for? I mean, you have everything paid for, you have no debt. What do you need this for? When you kind of peel back those layers, it's always, need it for long-term care. And if that's going to prevent you from enjoying your other funds, why don't we take some of that, put it in one of those hybrid policies, which again is set aside, that it's a way to, it's a better way to self-fund, if you will, because at first you're just spending your own money, but now you get the leverage of that, maybe that lifetime coverage where it will pay for the rest of your life. And it gives you some freedom to enjoy some of your money, not worrying about need it in the future. And so that would be what I would kind of say to some of those clients, that I'll just spend it for myself. I mean, you could run through and mathematically, sure, you might have enough that you could self-fund this. I mean, that's not really the question. The more is it's from a behavioral standpoint. And this is back to your earlier point of just trying to talk these 80-year-olds, who've done
85, 90.
I
mean, I've been there a whole bunch of times, and they have thrown the people out. The daughter set them up remotely. They came in, and what the old guy says, all they do is watch TV, or the lady, she's saying, I thought they were supposed to clean, and they're in there gossiping or out back smoking, or they're just going to come up with something. And the reality is they don't want them there.
Right.
And I'm thinking, when I'm 85, I don't want them there either.
Right.
But the reality is they need to be there, because the daughter takes some comfort in there. And there's just a lot of resistance of getting well-to-do people that are savers to actually spend their money that they've described 10 years earlier as there for long-term care. That just doesn't play out very well. And so I'm thinking, when I'm talking to people that are in their 60s now, don't let that be you. I mean, just get a plan together and get some funding in it, and then talk about it with your kids. So if this happens to you, you're just not going to have that issue.
And I will also say the time to do this is when you're healthy and you don't need it. I mean, oftentimes it's like, we don't get this as much anymore, but I'm healthy. I don't think I'll need the care. And when really, a lot of objections really stem from the fact that they don't think they're going to need it. And so, that's the best time to buy it, because as soon as something happens to you health-wise, it becomes much harder. Your options get limited. Like if I were to go try to buy a policy right now, hopefully in the future, maybe I'll have more options. I don't think I would qualify just with my condition, having been so recent, and having, no insurance company is going to want to take me if I'm, 5 years ago was in a wheelchair and couldn't walk. I mean, that's just.
My mom was healthy as a horse when I sold her that long-term care policy.
Right.
And she was 72 years old, I think, or 73 when my father passed away. And people tell me that I'm healthy. Well, you're the very guy or lady that is so healthy and you're in shape, you're going to live to 95. And guess what happens to people between 85 and 95? They get dementia. So, I mean, the people that are sick, first of all, they can't buy it, or they're going to have to go with an annuity, or, we're going to have to rig it up. So you got to be healthy to buy these things, or reasonably healthy. And then furthermore, you're the person that's going to live long enough. People that are sick, they pass away and they never use the thing.
Right.
So it's the healthy people that need the stuff.
Sure. We have another question here. So do these policies affect any state/Medicaid partnerships?
Okay. Well, I mean, it's great somebody brought that up, because I consciously left it out, because the partnership program is a very good program in theory. And what it really says is that if you buy long-term care insurance that's partnership qualified, and most states have a partnership program, that you can protect that amount of assets and still go on Medicaid. And then when you die, your kids get that protected benefit. So it's bringing the Medicaid people or the state in partnership with the insured to where they can go on Medicaid with some protected assets. But the reality is, most of the people that would benefit, they can't afford long-term care policies. Or the people that it will benefit, or benefit in theory, have too much money to spend down to that benefit. So one of the reasons I just left it off there is I think there's a lot of discussion about something that doesn't really play out that often.
Sure. Yeah, I mean, I think that's a good point. I mean, I think that really, if you have someone sort of with maybe $100,000, $200,000 of assets, really want a long-term care policy, it potentially could protect some of those from that. I also see a scenario. I mean, again, not trying to get too far into the Medicaid system, but one of the things that happens is what's called the essentially the clawback or the estate recovery, and each state has their own way to do it. But what that looks like is when you pass away, things like your home, which was not counted for, was not able to be counted for in terms of qualifying for Medicaid, is then the state is able to go and put a claim on that, and that they do that through the probate process. We don't want to get into all the details there, but a policy that is partnership qualified for the right client that has maybe some means but not a lot, it potentially could help. But again, like to Hans, like you were saying, it's not in reality. I don't have the date on this, but
I was around when these things were invented, and they were only in like 3 or 4 states. I really loved them then. I said, man, we got to get this in our state. But then as they got all over the country, I'm going to stand by what I said, is that if you're really going to have enough assets to spend down to the level of your long-term care insurance, it just plays out that this is one of those programs that looks good on paper, but in practicality, it doesn't do that much for anybody.
sure. And I will also point out the really the only policies of the ones we've looked at today is the traditional long-term care policies. Those are going to be the one that potentially are tax qualified if they meet all the rules around that. And so any of the hybrid policies aren't going to meet that
The partnership.
they're the partnership qualification, right? Well, so one last question here, John, is, and this one is, what long-term care do you have, and why did you purchase that one?
The second one we talked about, I got it through One America. I'm done paying premiums. I paid premiums over 10 years. I put 130 grand in there. The cash value is about 130 grand. The death benefit is $300,000. It's a joint policy. It covers my wife and me. If we die without using it, our kids get 300 grand. If we use it, it's going to be the best decision we ever made. I'm all about this, and we talk about it all the time,
Sure.
in here. And but any of those policies in the 9 that we went over would be just fine. So
My hope is as I get a little older, they've gotten better underwriting, and I can sort of squeeze in at some
we're
point.
going to figure out
yeah.
something
Right,
Tom,
right.
before I'm gone.
So
Tom's the legacy plan here is that if you buy this stuff at 65 and then you're really needing it paid off on 85, you got a much better chance of getting a hold of him. So, and we'll do consulting for anybody that's, you're out there, one of your clients, somebody we do Zooms all day long. We're, licensed in all 50 states and DC. We're registered in most of them. So it's a really good business that we've built here.
yeah, and I think if you have, I would definitely download the handout that we've included as part of this. Look through that. If you have questions, our contact information is there. Reach out to us. We'd be happy to just answer them, and just whether for you or for clients or whatever it might be, just reach out.
Well, you made it 90 minutes, and you made it this far. So if you probably have some questions, or I would suggest you look at the show notes. And if you do, give us a call. I just want to bring Tom on to say goodbye and any comments Tom has.
Yeah, I mean, I think if you made it this far, you're clearly somewhat interested in this topic. All of these were not specific to you individually, so call us. We can run different proposals. These are very customizable to what your needs are. So let us help you sort of get this planning started.
Thank you.
Thank you.